Hello friends, welcome to CEC live lectures. Myself Aditya P. Tripathi. I am here to continue our discussion on the topic of marginal costing. So as I told you in my previous lecture about the basics of marginal costing, I tried to explain to you the meaning, definition and assumptions of marginal costing. I hope and I believe that you must have understood what exactly we have to do in this technique of marginal costing. Now after precisely understanding the meaning, definition and assumptions of marginal costing, now I will move on to the marginal costing statement. Although the same statement I explained to you in brief in the previous lecture, but for your reference I am showing it again to you. What we do into this statement, we are actually we should be reminded of this statement whenever we are applying marginal costing technique in our numerical problems. Suppose I have written sales, I have to find out the variable cost from the question. So there are 3 or 4 components of marginal costing. We need to first find out the sales, the value of sales in the question, then variable cost and then fixed cost. If these 3 components are known to us, we can very easily prepare marginal costing statement. Sales minus variable cost is known as contribution, and if this contribution is known as contribution cause, it contributes towards 2 important aspects of our business. First is the fixed cost, another is profit. So after recouping or after recovering the fixed cost, whatever is in residue, whatever is in balance, that is known as profit. So that is why we say contribution is equal to fixed cost plus profit, or you can say once you deduct fixed cost from contribution, you come to know about the profit. And we have to first understand what is my contribution from this statement, what is the carry home point, take home point, that sales minus variable cost is known as contribution. This is a formula which you should remember as far as the practical problem of marginal costing is concerned. Sales minus variable cost is known as contribution. Then what is contribution? Contribution is equal to fixed cost plus profit. So if you keep these 2 formulas in your mind, it is quite easy for you to prepare a marginal costing statement. Sales minus variable cost contribution, and contribution is equal to fixed cost plus profit. Now the question comes, how do we apply marginal costing? What is the application of marginal costing? What are the different uses of marginal costing? Unless you know about this, you cannot go for applying these tools. So first and the foremost application of it is profit planning. You can plan your profit, that if you are going to change your level of production, what will be the impact of change in level of production on the profitability of the business. So we all understand that your business cannot flourish for long, we cannot survive for long without profit, and that profit we can calculate with the help of marginal costing. We can understand that after deducting variable cost, whatever is in residue, that is called contribution, and if from your contribution you are able to recover your fixed cost, then obviously there is a great possibility of you saying that my business has booked a profit. Now what is that quantum of profit? That you can only tell after deducting fixed cost from contribution. So you can actually plan your profitability, that if my sale is actually increasing in this proportion, say by 20%, what will be the change in my profit or profitability. So you can plan for your profit because your fixed cost in total remains constant. So there is no problem you worrying about the fixed cost. It is only the variable cost which is a point of concern for us. So the first application of marginal costing is you can plan your profit as a manager. Second is you can go for taking a product pricing decision. You can make a decision that what should be the minimum price of my product. In most of the government contracts, whenever you have tenders, you are being asked to quote a minimum price. But remember, in a race of taking that contract, there is a great possibility that you may end up incurring huge loss, and obviously you cannot survive with the losses. So what should be the minimum price which I should quote today? In place of repenting or having a great remorse after taking that contract and fulfilling those services, you are saying that what exactly I did, why I took this, I applied or I took this decision, why I had quoted this minimum price. I should not have quoted. What is the point of taking that contract when it is of no benefit to you? So suppose if some government contract or in any of the tenders or in any of the say export orders, suppose if there is a question what should be the minimum price I should quote, Because if you are quoting on the higher side, obviously you stand no chance of you may actually choose for losing that chance of getting that contract. So first is, if you are going on the higher side, then there is a chance of you losing that business. If you are going on the lower side, then there is a risk that you may end up incurring huge losses. So here comes the role of marginal costing. You can decide your minimum cost, that even if I am not receiving this order, in any case I have to bear with my fixed cost. I have to pay my factory rent, I have to make payment, I have to charge depreciation, I have to pay my electricity bill, although I am talking about the minimum rent only, not the consumption charges, but still there are some charges which are known as standing charges. So minus those standing charges, we have to find out the variable cost, and that is why in most of the export orders we don't bother about the fixed cost, we only talk about the variable cost plus some amount of profit. So if it is giving me, if it is giving me say 5% or 10% of profit on my variable cost, then too we can go ahead and we can take a decision. Another application of it is we can control our cost. Now at times my students are asking me, sir, what is the difference between cost control and cost reduction? Is it the same? See, cost reduction means you are trying to somehow compromise with your functioning. You are going to compromise, you are going to reduce your consumption, then you are going to say that I have reduced my cost. But when we talk about the cost control, by remaining in the framework, it is just like I am telling you that you have to reduce your electricity bill, so you thought of not using air conditioners at your home, or you thought of waiting for afternoon, until then you are not putting your AC on, and you are just waiting that I will be consuming it for lesser period. That may be a cost reduction strategy. But for production you cannot compromise with the quality, you have to control the cost within the framework. So you have to find out those costs which are controllable, which you feel that it is actually a abnormal kind of cost, and that is what this marginal costing technique does. It actually tries to tell you about those costs. You can control the cost, you can find out the variable cost. Second is impact of fixed cost. This is one of the most you can say significant technique which helps you in understanding the impact of fixed cost. That you retrieved your variable cost, there is a contribution, but the moment you saw that fixed cost, you declared that there is no profit, we have incurred losses. So impact of fixed cost is beautifully explained by this technique of marginal costing in management accounting. And obviously for all your decisions, managerial decision making in your decision making process, this technique is one of the most important technique, because it actually tells you whether you should accept an order, or whether you should continue or not, whether you should make or buy, and there are a number of decisions which you can take with the help of this technique. Now coming to the numerical aspect of it, cost volume profit analysis. Now at times my students are asking, sir, why do we call it CVP analysis? What we are doing? See, in this CVP acronym, if you concentrate, you will find three terms in place. One is cost, another is volume, and third is profit. Cost you understand, profit you understand. But when the term volume comes, you are little confused. What is volume? Volume is actually your quantity produced. So in what quantity you are making your production, in huge quantity or in smaller quantity, in smaller batches or in larger batches, that is what you have to understand. Now in marginal costing, or you can say in CVP analysis, what we are doing, we are trying to change the volume. When I am saying change, it is either way, either I am increasing or I am decreasing. So I am just trying to examine the impact of change in the volume on cost, one, and secondly on profit. So what is the reaction in my cost, in terms of my cost or profitability, or you can say in costing, when I am changing the volume? You all understand, when you are increasing your volume of production, there is a term called internal and external economies. You are going to purchase raw material in bulk, so obviously you will be getting the benefit of bulk purchase. If you are producing in huge quantities, your workers will get trained, and obviously they will be more skillful than earlier. So in other words, you can say you can magnify the effect of your fixed cost, or you can say with every increase in level of production, your per unit fixed cost actually reduces, which is explained by the teacher of economics when they talk about AFC curve. telling you about rectangular hyperbola, but that is not our point of discussion here. We have to simply understand that what is the impact of change in volume of production on cost and profitability. So this behavior we have to actually examine in this topic of cost volume profit analysis. We are just trying to examine the impact of change in my quantity produced on cost, number one, and number two, the profit, whether they are in our favor or they are going against us. So if cost is reducing, then obviously they are favorable. If profit is increasing, obviously they are favorable. Otherwise they are unfavorable, or you can say adverse. So in cost volume profit analysis, we will be changing the level of production and we will try to witness what is the impact of it on cost and profit. Now this CVP analysis is actually using two important techniques. One is known as PV analysis, or we call it profit volume analysis, and second is break even analysis. So in most of the books they have classified it like this only, that CVP analysis is actually using two important techniques. One is profit volume analysis and second is break even analysis. At times my students are coming up with this complaint that, sir, some authors are giving a different way of using these techniques. They are giving different names, they are making a different nomenclature, they are assigning different nomenclature to the chapter. Don't bother about that, because in management accounting, obviously since we don't have any accounting standard like we have in case of financial accounting, here we don't have any standard. We don't have any accounting standard, we don't have any regulation, because it is not mandatory. It is actually for the consumption of management. Management has to make a decision, so they want management friendly information, and that is why you will not find any uniform kind of classification of the chapters. So you have to keep this thing in mind, that this CVP analysis is using two important techniques. One is the profit volume analysis and second is break even analysis. Now I am starting from the contribution to marginal costing equation, or PV, profit volume analysis. Now contribution, you all understand, sales minus variable cost, I told you, and contribution can also be defined as fixed cost plus profit. Now the question comes, what do we do with the contribution? With the help of contribution under PV analysis, we will be computing profit volume ratio. So what is the ratio between the volume and profit? As I told you that in CVP analysis, we have to examine the impact of change in volume on cost and profit. So PV ratio is actually dealing with the profit and volume. So what is the impact of change in volume on profit? That is depicted by the profit volume ratio, and that is why it is also known as contribution to sales ratio. We can also calculate the relationship between contribution and sales. Now what is profit volume ratio? One of the most established formula is contribution upon sales into 100. Profit volume ratio, or it is also known as PV ratio. PV ratio is equal to contribution upon sales into 100. Or if you elaborate, if you expand the numerator of it, you can say sales minus variable cost divided by sales into 100. So they stand for the similar meaning, because you have only expanded in the later formula, you have simply expanded the numerator, that is sales minus variable cost. We all understand that is contribution upon sales into 100. After this, knowing about this formula, we have another formula, second formula for computing the profit volume ratio, which says that suppose if you are provided with the figures of sales and profit of two periods, they are reporting you the profit of say 2020 and 2021 along with the sales of 2020 and 2021, and students are complaining, sir, how to calculate PV ratio? Because the ingredient of this formula is not available in the question. You told us contribution upon sales into 100. There is no variable cost given in the question. How can I calculate contribution? My dear students, for that you will have to know the second possible formula of PV ratio, the second method of computing PV ratio, which says that change in profit upon change in sales into 100. So your numerator is change in profit, your denominator is change in sales into 100. So you have to always keep this thing in mind, that we have two sets of formula for PV ratio, and depending upon the type of problem you are dealing with, you may decide, you may choose which formula to apply. Now I'll be explaining to you how to calculate PV ratio under different situations, so that you can numerically understand the way we calculate PV ratio, because unless you understand the PV ratio analysis and break even analysis, you can't take decisions or you can't make decisions. So let's start with the situation number one. Suppose in this situation you are provided with the value of sales, amount is rupees 20,000, and the cost of your variable cost is given to be 15,000, and they are asking you to calculate PV ratio. Quite simple for you to calculate. The first and the foremost thing which you have to do is get reminded of the formula. Formula for PV ratio is contribution upon sales into 100, or you can say sales minus variable cost is equal to contribution. Here your sales is 20,000, your variable cost is 15,000, contribution becomes 5,000, that is your numerator. Sales is 20,000. When you solve it, you find the value of 25%. Now this 25% is your PV ratio, or you can say contribution to sales ratio in this situation number 1. It is the simplest type of problem where you may be asked to calculate PV ratio. Coming to the situation number 2. Now again you have to calculate the PV ratio under situation number 2. Your variable cost is given to be rupees 60 and contribution is given to be rupees 40. Variable cost per unit is rupees 60, contribution is given to be rupees 40. Now you must be thinking how to calculate. Contribution is given, variable cost is given, but sales is not given. So you have a formula, profit volume ratio is equal to contribution upon sales into 100. But the question comes, you are saying that sir, contribution is there 40 rupees, but sales is not given. How to apply this formula? So 40 by 100 sales I have written. The question comes how to calculate sales. We all understand sales minus variable cost is actually your contribution. So if you know variable cost and you know contribution, by simply adding variable cost into contribution, you can find the value of sales. It's a little slightly tricky question where the sales is not given. They are giving you variable cost and contribution. So you have to simply add these two values, variable cost and contribution, to find the value of sales, and the sales becomes 100 rupees. 40 by 100 into 100 is giving you the PV ratio, that is 40%. So my dear students, you may not find the stereotyped kind of situation where the sales and variable cost is given and you have to simply put the value and get the answer. Examiner may give you a situation, may put you in a situation where the sales is not given, variable cost and contribution is given, and you have to apply. What you have to do is you have to simply apply your common sense. So here what we have done, what is our learning from this situation number 2? Learning is sales is equal to contribution plus variable cost. So for sales also we have got a formula. Sales is equal to contribution plus variable cost. So by simply putting the value into the marginal costing statement, you can find the value of say contribution, or you can find the value of sales. Just like in this situation, we have calculated, we have computed the value of sales to calculate PV ratio. Now moving on to the situation number 3. Here, before proceeding with the question, I am telling you the learning point. Learning point will be we will have to define the contribution here. Contribution is equal to fixed cost plus profit. So we are having a assertion that contribution is equal to fixed cost plus profit. Question is giving you profit rupees 5,000, fixed cost rupees 8,000, sales rupees 25,000. So they are giving you these three values: profit, fixed cost and sales. My dear students, they are not giving you the variable cost. So examiner may play with any of the figures, or situation may have different angles. Like here in previous problem you didn't have the value of sales. Here you don't have the value of variable cost. You have fixed cost and you have profit. So you need contribution and sales to calculate PV ratio. Very simple. You have to compute contribution, and you all know formula of contribution. One is sales minus variable cost, another is fixed cost plus profit. So fixed cost is 8,000 rupees, profit is 5,000 rupees. When I add it up, it becomes 13,000. So contribution becomes 13,000, sales is 25,000, and when I put the value in the formula, contribution upon sales into 100, I get my PV ratio to be 52%. So this was a situation where the variable cost was not given. So you may find number of situations where in one situation and the other, in some of the situations they'll give you the value of sales but not the variable cost. Somewhere they'll give you the value of fixed cost, not the variable cost. So in this way you have to apply your common sense. You have to stay very alert while computing PV ratio. calculation of PV ratio in situation number 4. I am giving you this fourth situation. Why I am giving you all these situations? So that according to the problem which you are witnessing, which you are dealing with, you can apply, you can calculate the PV ratio. Here it is, the question reports ratio of variable cost to sales is 79%. Now students are saying, sir, you didn't tell us about the variable cost ratio. Obviously, when I am saying contribution to sales ratio, there can be a possibility of variable cost to sales ratio. So here comes the role of another formula for PV ratio, which we discuss in due course of our lectures. 100 minus variable cost ratio. 100 minus variable cost ratio is also known as PV ratio. You can say 1 minus variable cost ratio in percentage. So if I say the total sales to be 100 and variable cost is 79%, what is my contribution? Obviously the remaining value 100 minus 79, and that is 21%. So you can straight away say that PV ratio here is 100 minus variable cost ratio, and this 21% is your PV ratio. So we cannot apply the typed formula of contribution upon sales into 100 in all situations. That's why I have stricken it out that PV ratio is equal to contribution upon sales into 100. Formula is correct, but we cannot apply it here because question doesn't provide us the sales or contribution. It is simply providing us only the ratio of variable cost to sales. So here the PV ratio, the new formula for PV ratio into our kitty of formula is 100 minus variable cost ratio. Now we have got three sets of formula for PV ratio. One is contribution upon sales into 100, second was change in profit upon change in sales into 100, and third is 100 minus variable cost ratio, or you can say 1 minus variable cost ratio. When you are taking 1, always remember, don't take 79%, solve it. If you solve 79%, the value becomes 0.79. So 1 minus 0.79 will be your PV ratio. Multiply it by 100 if you wish to compute it in terms of percentage. Now there is another situation to calculate PV ratio, the fifth situation, which is actually dealing with the second formula, which I explained to you at the very outset. If you look at the table, you are provided with the sales of 2020 and 2021 to be 50,000 and 60,000. Your total cost given is 40,000 and 45,000. Your profit is given to be 10,000 and 15,000. And you all know that here we cannot apply the formula of contribution upon sales into 100. Some students, they start trying to calculate the fixed cost, then variable cost, and ending up with no answers. They are helpless how to calculate if they are not aware of this way of computing PV ratio. So to avoid that kind of situation for you, I am explaining it here how to calculate PV ratio when the value of sales, total cost and profit is given. Very simple. Your formula of contribution divided by sales into 100 becomes redundant here. I cannot apply this formula. So I'll have to go for the second formula, change in profit upon change in sales into 100. My dear students, mind here, I'm not saying increase in profit divided by increase in sales. I'm saying change in profit divided by change in sales, and change can be increase or decrease both. So change in profit, if you look at the table, is by from 10,000 it has become 15,000. So change is 5,000. Sales was 50,000, it has become 60,000. Obviously there is an increase, 50,000 to 60,000, it has become 10,000. So your change in profit is 5,000 divided by change in sales 10,000. I have multiplied it by 100 to arrive at PV ratio, and here my PV ratio is 50%. So you can very simply calculate PV ratio when the value of sales and profit is given. At times examiners, they try to they want you to run some extra miles, or they want you to do some more calculations. So in place of giving you the profit straight away, they are only giving you the first 3 columns of this question, year sales and total cost, and they expect from you to calculate the profit, right? So sales minus total cost, very simple, simply you can calculate 50 minus 40, 10, and 60 minus 45, 15. So they may also expect from you to do the calculations, because teachers have a lot of hope from you. They have great expectations from you when it comes to drafting a examination question paper. So and even into the corporate setup, you should know if the value of sales and profit is given, how to calculate PV ratio. Now the question comes, after understanding how to calculate PV ratio, what is the advantage of PV ratio? Most of the times my students are asking, sir, what is the use of computing PV ratio? I told you this will help you in calculating break even point. At the very outset I told you this is going to help you in computing the break even point. That is the point of no profit, no loss, which I'll be explaining in the next lecture of mine. It is also an indicator of profitability. You can understand the profitability of your business. If your PV ratio is on the higher side, then obviously your profitability, the ratio of profitability will be on the higher side, because your fixed cost in total is constant. It is also used in calculating margin of safety. Now margin of safety means above break even point, what is the extent of your travel, extent of your production ahead of break even point is known as margin of safety. How safe you are, that I'll be explaining in the next lecture of mine. And then obviously you can also calculate the sales to maintain a given level of profit. Suppose you want to make a profit of say 10 crore rupees, you can decide a sales target for your sales people. So due to these advantages, we actually study PV ratio. My dear students, I hope in this lecture of mine you must have understood, you must have learned how to calculate PV ratio. In the next lecture of mine, I'll tell you how to apply this PV ratio in computation of break even point, in knowing the profitability, how to compute margin of safety, and many more concepts. I hope you must have enjoyed today's lecture of mine. Thank you so much.